Jim Bianco, Bianco Research. Always a pleasure to have you with us, Jim.
Thanks for having me, Ash.
Well, it's especially great to have you here today as we look ahead to 2022. I should say we're filming here on December 7th, 2021, and we're going to be looking ahead to 2022 in this conversation. But Jim, before we get started, for people who haven't seen a deep dive with you before, give us a little bit of a sense of how you as a TradFi guy got into the crypto markets in the first place.
Yeah, so I still consider myself a TradFi guy that has fallen down the crypto rabbit hole. I've been in in the traditional financial markets as a macro strategist. I run my own research firm for now almost 24 years. And I actually had another 10 or 15 years on Wall Street, traditional Wall Street, in the research effort before that as well, too. But I came into crypto in the summer of 2017. I opened at the time, I'm going to really strain your memory, a GDAX account. And I wound up buying some Litecoin, and I wound up buying some Bitcoin and Ripple, which is now XRP at the time. GDAX eventually became Coinbase Pro over time as well, too. And from there, I started watching the coins, starting understanding the coins, and just little by little over the last 4 years, I've been getting deeper and deeper into this space. I knew I was hooked in this space because in early 18, I bought some Ethereum. And by the spring of 2020, it was down 90%, and I still liked it. And I kept thinking to myself, this must be the first time I've ever bought something. It went down 90%, and I still think it actually there's something to it. Because most of the time, by the time it's down 90% in the traditional financial world, you're wondering who's going to be hauled away in handcuffs and how did this happen? But in the crypto space, it's like, nah, this is just a correction.
Yeah, and usually by the time it's down 20%, you've exited the position already. So you are officially now a 2017 OG. Let's talk a little bit about this.
Can you be an OG from 2017? I thought that was like 15 and earlier, but that's just
I think so. I think the longer that you stay in the space, like the later you can be an OG.
Okay.
I think you just have to define it, like a 2017 OG.
Okay. I'll take it.
So let's talk a little bit about 2021. You and I have probably heard at least 1,000 times this phrase. This is the year that institutional investors get into crypto. Maybe that's a little bit of hyperbole. There's probably some truth in it. How do you think about what happened in 2021?
It was the year that institutional investors stopped mocking it, because I can tell you that up until late 20, there was only a handful of people I could really talk to about this stuff. The rest of them just mocked it and thought it was, beyond Ponzi, Ponzi tulips, insanity. Those were kind of the words that everybody used to describe it as well, too. But at least in 2021, they started asking the right questions. Now, I know a lot of institutions that haven't really jumped in full blown, but they're at least thinking about it. So yeah, it was, I'm not going necessarily to the adoption part, although there's always going to be more adoption now than a year ago. In a year, there'll be more adoption than there was this year. But it was really the year where we just stopped making fun of it and we started thinking that it might be a serious thing.
So talking of the year ahead, let's frame it up. What are you looking at, Jim? Where do you spend most of your time? And what has caught your curiosity and attention?
As a TradFi guy, what I do like is the protocols. And I do like the idea that it is reconstructing a financial system. So I'm looking at the lending and the borrowing protocols. I'm looking at the DEXs and the other new DeFi protocols that are coming. I've been playing around by trading on some of the DEXs just to get a feel for how they work, staking some coins, borrowing against other coins as well too, participating in liquidity pools and the like, because that's where my interest is. Now I know a lot of other people's interests are, doing charts and then hoping that this coin will moon right after I buy it. Yeah, of course I like it when my coins go up. But that's not really where my primary focus is and hasn't been. It's been, is this going to become the new financial system? And the answer I think I've come to is yes. Now, it's not going to become the new financial system right away, but it's on its way towards becoming it. It is very, very early days as far as where we see this going. If anybody remembers, the earliest days of the Uber app didn't work very well. There was no there was no cars out there. It was frustrating to use, but eventually you could see where we were going. And now you look at how it's changed the human transportation system as well. And I think that we're kind of in that process as well, too, with what we see, at least in the protocols when it comes to decentralized finance.
Yeah, it's so interesting. We talk about crypto very often as being something that's very much a young person's game, people in their early 20s doing a lot of the development. But very often it's guys like you and me who have a few more gray hairs, who've actually seen these cycles, who've watched adoption curves, who've watched sort of initial hype. But when you see something there and you identify something that's durable, that has a real sort of connection with the way that markets work, or the way that there's tremendous demand for something, you can overlook that drop when you see it come down from peak. This is the way that markets work, and adoption cycles are not smooth. It takes time for new technologies and for new paradigms to come online.
Yeah. Oh, absolutely. And also, when you talk about, you have a couple of gray hairs and you've seen some of these cycles too, you also have to keep in mind vested interests. There are a lot of high profile TradFi guys, Jamie Dimon, that will say nasty things about it, but you would almost expect them to, because if we are creating a new financial system, who's on the losing end of that? It might very well be Charlie Munger, Warren Buffett, and JP Morgan. Now, maybe they can adapt and adjust, but right now they're at the top of the heap, and it's going to be hard for them to stay at the top of the heap if we have a new system going. Maybe because I work for a small firm with my name on the door, I can be a lot more nimble, a lot more flexible, a lot more open-minded at change. I can be a lot more accepting of failure, or maybe not. But that's why I say I can see these cycles and I can see where they're going. And also, who also is on the potential losing end of a new financial system being built? The Federal Reserve, the Office of Controller of Currency, the Department of Treasury as well, too, and the issuers of the U.S. dollar and of all fiat currencies. So I understand why they're pushing back against this as much as they have been.
So, Jim, one of the things that's interesting to me is, as someone who's very much a TradFi guy, someone who's traveled in Wall Street circles for a very long time, you talk to people in the TradFi space. What's the sense that you've had in 2021 of the transition in thinking about how people are conceptualizing this space? You mentioned earlier that while there may not be mass adoption, it's not being mocked any longer.
Right. And I think one of the reasons it's not being mocked is, even if you go back a year ago when it was being mocked, or a year and a half ago, and of course earlier, if you ask them what was cryptocurrencies, it was Bitcoin, something with a dog on it, and it was this magic bean that went up or down and didn't serve any purpose at all. They didn't understand what was coming in terms of the protocols. They didn't understand, lending and borrowing and staking and liquidity pools. And now that they're becoming aware that those things exist, it is becoming, okay, maybe there's something more to this than just buying some doggy token and hoping that it goes up 100x in a week. Yeah, there's that too. But that's not where a lot of people are focused right now. And that has been the realization. So in other words, I think, to put it in blunt terms, what changed it was DeFi Summer. Was when DeFi Summer came in 2020 and they started to become aware of this thing called DeFi. That's what really started changing thinking. Now, the problem that a lot of them have, I think, is, yeah, we should get involved in this. And then the answer is, well, let's buy some Bitcoin. Well, no, I want to get involved with that DeFi stuff. And they're not, they got to start, first of all, you got to open an account and buy something to get going before we start actually talking about where on the curve in an Uniswap L3 pool are you going to stake your coins. That's coming later as well, too. But eventually they're going to get there, I think. And that's really where the adoption is. Right now, like I said, if you're talking about what was the adoption in 2021, open an account and buy some coins. What is going to be the adoption in 22 and 23 moving forward? Stake them, borrow against them, lend against them, learn how to work these liquidity pools, yield farm. That kind of stuff, I think, is really what's coming next.
Jim, I'll tell you kind of a cool story. So I've been taking this online class about the history of the Industrial Revolution. It's taught by a Emory University professor named Patrick Allett. It's a fantastic course. Hopefully, I'm going to try and get him on in 2022 because I think it's such an amazing way of thinking about history. And he tells the story about the guy who invented the railroad. The first railroad steam-powered locomotive engine was invented like around 1805, and it basically was building on technologies that had already existed, very much like cryptocurrency. They were the big steam engines that they used to drain mines, and then the mine tracks that they would lay to move coal and physically move coal on hand-pushed carts. This guy put these two technologies together, and he built the first steam fenced off a circular track, had the damned thing drive around in circles, and charged people $1 to see it at the state fair. People looked at it as a curiosity. It was this silly little thing that this guy had done. And it took years before people figured out that there was a commercial use. I mean, can you imagine that? This is the single most significant 19th century industrial revolutionary. Now, there's also this other interesting metaphor about the people who know the history of the Industrial Revolution. Railroad stocks, railroad bonds fluctuated dramatically in price. But at the end of the day, that technology changed the world. It changed the way people did business. It changed the way they traveled. It changed the entire scope of the economy. And it's such an interesting metaphor for some of the points that you just made, thinking about what people do or don't do with cryptocurrency, how they've used it in the past, and how we may be using it in the future.
You know, a couple of thoughts for you. First of all, to stick with your 19th century example, I do know that the railroad industry was so big that one of the legacies that we have from it is time zones. That was so important to get all of the trains on the same time because they were crashing into each other because there wasn't an accepted world order for time. So then they came together in the late 19th century and made Greenwich Mean Time the center, cut up the world into time zones, and then made an official time so that every conductor's watch would be on the same time as well, too. The point being of how important it was. But yeah, what usually happens with technology, as we've learned with the internet and stuff, when you come up with a new technology, you don't want to be 5% better or 10% better. You want to be 5 or 10x better. And when you are 5 or 10x better, what you have done is you have redefined the business models and you have redefined the use case for the technology. That might not be immediately apparent right away, but it does become that over time. Look, I'm old enough to remember the early 90s, and I'm old enough to remember people asking, what's the point of the internet? I'm old enough to remember Paul Krugman's famous 1998 missive when he said that the internet will be as important as the fax machine as well, too. That's because the technology was so transformative that it took years for us to get our head around, what do we do with this? You're starting to not only see that with cryptos, you're seeing that with Web3, you're seeing that with the Metaverse as well too. So you're seeing that obviously with DeFi and with NFTs. You've got a whole bunch of them coming together all at once.
Yeah, Jim, that's so well said. So many important points there. And even when the technology is 5, 10x better, sometimes incumbents ignore it because they don't like interrupting themselves when there are billions of dollars at stake. No surprise there, right?
Right. It is the incumbent dilemma, right? As we've learned from, at least as I've read and understood about with Uber, the taxi cab companies, they had this idea of this app where you push this button and the car shows up and you can do all this stuff. But they're also tied down to, I've got this legacy business model that will make me money today. I've got this new idea that won't make me money today, but might be very important in the future. So do I take this perfectly good way to make a living and just blow it up on the hope that this new thing will be better? And the answer is no. And that's why it takes somebody else to come along. So a lot of the legacy businesses are looking at this and they're saying, there might be something there. But when JP Morgan flips on the lights tomorrow morning, they make money. This new idea may or may not make money. And there is where the dilemma, the legacy dilemma or the incumbent dilemma lies in why it usually takes startups and visionaries that are completely outside of the business in order to jump in and make something of it.
Yeah. And by the way, I'm 68 years old and I have a fiduciary obligation to my shareholders. And I've been running this business for X number of decades. And we're just going to keep the bus on the road until I retire.
Exactly.
So, Jim, the past is prologue. It's very well described, very elegantly explained. Talk to us a little bit about what you see coming for 2022.
I think the big event of 2022 is definitely going to be the merge in ETH 2.0. Right now, Ethereum is a proof of work consensus protocol. So in other words, it still uses that whole same way to settle all of its transactions and to secure the network that Bitcoin does, that gets criticized for being slow and being energy inefficient. It is now moving to a proof of stake model. It is expected that in the first half of the year, if not the first quarter of 2022, there will be a move over to ETH 2.0 or proof of stake, and then they will merge with the old version of ETH, and we will be moving forward in a proof of stake concept that will basically open up the ability to scale Ethereum in a way that it has not been able to get scaled to date. One of the problems that we've learned now with Ethereum especially is that the scaling has really become a problem in the form of high transaction fees, or called gas, as well, because of all the NFTs, all the protocols that require complex transactions. It is very expensive to work on the Ethereum protocol. And one of the stories of 2020 was all of these alternative blockchains that have come along, whether they're Solana or Avalanche or Polkadot or Cardano, that have offered fixes for this in high transactions per second, but maybe a little bit less decentralization as well too. And they've really all taken off. And I think late in 2020, we realized, at least I did, that they don't have the answers either. Because what happened with Avalanche is that they started getting so popular that their gas fees started to shoot up. And basically, the answer is all of these blockchains are going to run into a problem of having high gas fees when they get to the adoption level that Ethereum has. No one blockchain has got the answer that, oh, the entire 5 billion people on the planet could come and trade their brains out on my blockchain, and it will always be less than a penny to do a transaction. No, the only reason that the Solana network or Polkadot or Avalanche were so low in fees is because you didn't have the mass adoption to it. But when it gets there, they're going to run into those fees. Now, along the way, we're going to see Ethereum come with ETH 2.0 proof of stake and the ability to start scaling it, relieving those gas fees, hopefully in 2022, the transaction costs. And if that happens without incident, as envisioned, that could really open the game for the Ethereum network to really take off. If you were to ask me what's holding it back right now, is transaction costs. Boy, there's a lot of really interesting protocols. And then I go there and I go, maybe I'll stake some coins, buy some coins, stake some here, lend some there. And I'm like, holy crap, look at the fees I got to pay to do this. I mean, I'm not going to make money doing it. I'm going to do it just as a learning process, because whatever promised high APY they're going to give me is going to get chewed up in transaction fees or gas as well too. But if that could be eliminated, wow, then we could really start to see the network go.
Jim, I think you framed it perfectly. Those really are the key issues for 2022 on the Ethereum and other L2 sides. Two important points that I think are critical to make here that are very much open questions. So we talk about these other L2, these other L1 layer one protocols that are being used as basically as Ethereum substitutes, places where smart contracts can get executed. You named some of these. These are the Avalanches, the Solanas, the Cardanos, the Algorands of the world. What seems to be very much an open question is the extent to which The fees are lower on those networks on the one hand because of lower transaction volume, therefore there's less congestion and fees are lower. And the second hand, which is this idea that the protocols are engineered to be for higher volume transactions. That's still something that's very much an open question. It's disputed. There are those, particularly partisans of those particular protocols, who will say, yes, it is true that transaction volume is lower here, and that obviously contributes to lower gas fees. But in their view, they believe that the engineering of the protocols make them less susceptible to the kind of high gas fees that we see on Ethereum. So that's still, as we say, very much an open question. That's point number one.
Can I jump in there now?
Please,
and just
please.
say yes.
Yeah.
It's the trilemma that they're looking at. What they've done is they've done away with decentralization in order to get scalability. And of course, when you do away with decentralization, you open it up to the idea of permissioning, and you open it up, to other ideas that that the network might not be as secure, because if there's only a handful of validators, if you could get at one or two of them, you can get at the whole network as well. And the concerning part about that is their argument was, okay, we'll scale first and we'll decentralize later. The problem is if you go to the original one, the Binance Smart Chain, which is probably the original Ethereum killer, I'm still waiting for them to decentralize. They have yet to really make any movements towards decentralization, and neither have any of the other ones. And if you don't, we're going to wind up, if you get large adoption on a centralized network, then the government could come in and put rules on the Solana network or put rules on the Binance Smart Chain network and say, okay, here's who can trade here, who can't trade here. Here's the rules for when you trade. We want KYC. We want all the stuff we're trying to get away from in the traditional system to be slapped on that system. So I get the idea. Let's scale first, decentralize later. Who's actually doing the decentralizing later part of it? That's why I tend to lean more towards Ethereum as being the idea of let's stay decentralized and work on the scaling. And if I might add one other one, let's not forget Bitcoin, because with Bitcoin, you've got the Taproot upgrade that came. The Taproot upgrade will allow Bitcoin now to maybe have smart contracts, its own protocols as well to start looking more like some of these other networks. Let's see if that is really what happens 365 days from today, in order that we then start to see, a Bitcoin DEX run through that Taproot, or a Bitcoin borrowing or lending program, or some kind of version of if I could use the phrase, a Bitcoin 20 token or something along those lines. Whether or not Bitcoin can actually play in this game as well too. They're going to have another real problem too, because their transaction speeds are even slower, although they do have the Lightning Network to try and alleviate that.
So once again, Jim, you've summed up many of the key issues that we're looking at and thinking about here. Just to bring everyone along, let's talk a little bit about what the Trilemma is, because it's really so critical to everything that we're talking about here. This is the idea that there are trade-offs between fast, secure, and decentralized networks, and that those three propositions are sometimes working, in fact, always working at cross purposes to each other, so that you can optimize for one or two, but optimizing for all three simultaneously is very challenging to do. I know that there are probably people out there who, again, are partisans of this or that L1 protocol who would argue that they are, in fact, truly decentralized. But the point, then it does open it up to a kind of legal or regulatory dispute saying, hey, if you guys aren't a truly decentralized network, that means that you can come, that you need to do AML, KYC, do all of these other things. This is something that individuals are controlling. So why aren't you compliant with this huge body of securities and banking regulations? The second point I wanted to make, just to carry over from earlier about the sort of the two key challenges. So this idea of the question about whether other L1 protocols will be better able to cope with transaction volume as they scale. I think the second one that's important to bring up, Jim, is this idea that the notion of the transition from proof of work to proof of stake is a very controversial one. There are folks, particularly it seems on the blockchain side, who believe that proof of stake networks have a tendency to become more centralized rather than less centralized. Now, again, it's probably important to at least frame out that perspective and saying that partisans of Bitcoiners are very passionate about proof of work as being the most secure and decentralized mechanism. So I know that that's a lot, but jump in, give us some thoughts to that and how you think about some of those issues more generally.
Yeah, I think you're right that proof of stake, under a proof of stake, a validator doesn't need all that massive mining equipment to secure the network. In fact, you could probably run it on a laptop in some of the cases. But then how are you running it on your laptop? You're probably running it through something like Amazon Web Service. And then when you add up all of the validators that run through like an AWS, then what you wind up saying is, okay, so Amazon's running the network because all it's got to do is lower the boom on all the validators that are using AWS. And there you go. We're back to being not decentralized anymore. And so there's been some proposals or some ideas to kind of push this idea that you can't use some kind of centralized service if you're going to be a validator like an AWS to power what you're doing as well, too. And I think that that's a really good idea. So, yeah, it is definitely when it comes to the move to the proof of stake network, it is, like I said, it's been a challenge. They've been working on it for years. I believe the original proposal to go to proof of stake was way back in 2016, and maybe we're finally going to get it now in 2022. So it is very controversial, but if it goes off without a hitch, and I'm not, a dev there, so I'll just, take their word for it that it will happen without a big problem, I do think it will be an enormous positive for the network, enormous positive for the whole crypto universe in the first half of 2022.
Yeah, you raise a sort of another key challenge, which is for finance folks who are thinking about these topics. These are things that are very much rooted in technological challenges. I should say that the trilemma is also sometimes framed as secure, scalable, and decentralized, speed being a function of scalability. But this dates back to the 2015-2017 cycle with the blockchain block size wars. That there are always these trade-offs between things like speed, universal accessibility. One of the values that's very important on the Bitcoin network historically has been the ability to run nodes on very low-powered hardware, like Raspberry Pis are one example of very low-power, inexpensive hardware that you can run a full Bitcoin node. And this is important to some people who are in the space, particularly in the Bitcoin space, who believe that this idea of universal access is incredibly important. However, as with all things in life, and especially in math and physics, there are trade-offs. And the trade-off there is that you compromise speed, processing power, and some of the flexibility. You talked about Taproot a little bit earlier. Taproot is definitely with some of the technology that are built into the new Taproot upgrade, things like Schnorr signatures and the ability to batch process transaction and the beginnings of some of the aspects of smart contracts. Clearly enhancements to the Bitcoin network, but Bitcoin is purpose-built to be a store of value, a kind of digital gold. And so it doesn't have some of the more advanced functionality that we've been talking about here with some of the other L1 solutions and with Ethereum.
Right, exactly. When you were talking about block sizes, you reminded me of that tweet that Elon Musk sent earlier in the year when he said, yeah, look, I could fix the problem with Ethereum in 5 seconds. Let's just increase the block size. And then, Vitalik emailed or tweeted at him, it's not that simple. And then, Elon scruffed, well, I started PayPal. I understand this stuff. Yeah. If you want to increase the size of the blocks so that you can put more processes or more transactions through each block, it means that the validators need more and expensive hardware.
Right.
You then shut out smaller validators. You concentrate the validators then to the big players that can afford more and expensive hardware.
Right.
And so therefore you have less decentralization. So you want to keep the blocks as small as possible. So you've got hundreds of thousands of people running these things on computers and laptops around the world. And then it's that much hard. So look, if you want to hack the network, you got to hack 85,000 computers all at once. Good luck doing that. But if you want to go to the other extreme, like the Binance Smart Chain, it has 21 validators. Look, I only got to get 11 of them. And I got the network then, as well, too. And by the way, they've had some problems precisely because of that as well, too. So That's why this block size and those block wars of 2015 and 17, it became a very, very important issue to try and work through.
Yeah, and there you go. Once again, you brought it full circle back to the trilemma: security, scalability, and decentralization, how those trade-offs work against each other.
You can pick two of them to do, but you cannot do all three. And that is the problem with the network. If you want to be fast and you want to be decentralized, you're not going to be very secure. And if you want to be fast and secure, you're not going to be very decentralized. If you want to be decentralized and you want to be secure, kind of like what Ethereum is,
right, you're
not very fast. But you can't be all three at once. And maybe proof of stake can help alleviate those problems.
Yeah, and in some ways, Jim, that's the sort of the perfect way to come back to what we're talking about today, which is the future and what we're going to be looking at in 2022. In some ways, these trade-offs kind of support this notion of a proliferation potentially of L1 blockchains, because if you're optimizing for different things, if you're solving for different sort of parameterized values of the trilemma, it suggests that maybe you have a world where you have multiple protocols that serve different purposes for different people in different circumstances.
I absolutely think that that's the case, and that you should. There's never going to be one blockchain that's going to be everything for everybody. You're going to want certain blockchains that are going to be speed. You want certain blockchains that are going to be for security. Look, and that's why we've got the L2s right now, the level 2 or layer 2 solutions in the side chains, the Polygons of the world as well. Ultimately, I think, my take is that if we were to look ahead beyond 22, 23, 24, you and me and everybody else, we should probably be up on some kind of an L2 and let the base layer be basically, to use a TradFi phrase, the institutional layer as well. The only problem with a lot of the L2s, whether it's Phantom or Matic or whichever one you're talking about, is when I get up there, there's really not a whole lot of the protocols that you could play around with. Yeah, there are some, but they're not as developed as what you're seeing in the L1 space. You've got a lot more, a lot more of the newer, interesting stuff is still in the L1 space. And you're like Olympus DAO or like Tokamaks, which are referred to as the DeFi 2.0s. And you're still, they're not ready to be up on an L2. Eventually they will be, but they're not yet right now.
Yeah, these are such important points as well. These sort of the different use cases, the different thresholds for security and what's needed. We obviously see this on Bitcoin and the Lightning Network. I mean, if you think about something like Venmo, which can be repudiated, you can reverse a transaction. If you and I go out and we have a steak dinner, and I stiff you for $50, and by retracting the Venmo, you probably just don't talk to me again. You're not going to be terribly upset about it. You go, okay, I'm not going to call that guy again for another steak. But if you're selling me, a used car and I'm giving you $20,000, you're going to be pretty upset if that transaction gets reversed. So there are all these sort of different use cases, all of these different types of transactions, all of these different circumstances where you can see these trade-offs sort of interacting in different ways.
Yeah, exactly. And in the crypto space, all transactions are final and irreversible. That when a transaction takes place, you're done. And when people have asked me, in the traditional space, and I've explained to them, maybe you should stick with a centralized exchange like a Coinbase or a Kraken or a Gemini or something like that, because when you get off, into MetaMask, when you get off into an electronic wallet and you screw it up, there's nobody to call. It's just gone. Move on with your life. That is very disquieting as well too. And then you add on to it the high gas fees. So, whenever I do a transaction in that space, I like to do it for like $100 just to make sure it works.
Yeah.
And then I do the rest of it later. It's like, man, look at all that. Now I got to pay 2x the gas fees because if they're not high enough already as well too. Because if I so much as put, a typo in the address, it's gone. And so you can't have that I've often said, just to throw out another little thing, a central bank digital currency operate in this space. Because a central bank digital currency will probably have some kind of a fraud exception to reverse a transaction.
Right.
Look, you send me the money, we do the trade, and somebody screams that the CBDC was done fraudulently, okay, we'll give the money back. You can't undo the trade in the crypto space. It's done. So that's what people also need to understand about how this space works.
Yeah, it's like that great scene in Wall Street where I think it's the Blue Star position is moving against Gecko and someone's freaking out and he says, what do you want to do? Call 911? There's just nobody to call.
Right, exactly. And once you understand that, it is disquieting, but then you also understand the need for it as well, too, because one of the problems with the traditional space is permissioning. You need permission to do things. You need, and it really does foster the inequality that the current financial system has. As I've said many times before, one of the insults to the public is this idea of an accredited investor. Okay, we've got these risky investments, hedge funds, private equity, venture capital. So we want to make sure that people that go into that space understand the risks. So we need them to be accredited. How do we accreditate them? Oh, you have to have $1 million net worth. So you've just told me poor people are stupid and rich people are smart. Is that really the message that you want to send along? Look, you're worth more than $1 million. You are a smart, special person. You're worth less than $1 million. You're less of a person. It is such an insult the way that we've got these permissioning set up when it comes to accredited investors. And that's what they're trying to do away with in the crypto space. Or one other one, I always rail at this idea when people write these books, invest like Warren Buffett. Boy, would I love to. I would love my phone to ring and be Brian Moynihan saying, Warren, my bank's in trouble. Here's a 9% preferred stock deal with this unbelievable conversion rate if you could take it this afternoon. Yeah, I'd love that too. But I don't get that. I'm not the special ones. In the crypto space, the only difference between me and him is the number of zeros we put after our transaction, but we both get the same deal.
You know, the other thing is I can get on New Jersey Transit and go to Sea Caucus and bet my entire paycheck on the Knicks, who, as always, are at the bottom of the Eastern Conference, and lose all of that money with a very limited potential for return. And yet, you know, people who aren't accredited investors are barred. And I understand, talking about trade-offs, I understand that the thought behind this is trying to protect investors from being hurt in fraudulent schemes. But it does seem like kind of a vestige of another age in a certain sense, doesn't it?
Oh, yeah, it definitely does, because I get it. When they made up the rules many, many decades ago, how else are we going to, qualify investors? And no, we're not going to say that, here's the list of approved colleges that you've graduated from that you get to invest in this stuff. And if you didn't, you don't get to invest in anything else. But it really does insult, and it really does take away from the young, because if you've just graduated from school and you're bright and articulate and you have a very promising upside, you might not yet have $1 million net worth because you're just, starting off. And therefore you're shut out from being an accredited investor. Eventually you'll get there. And there are plenty of people, the elderly, that have accumulated wealth over literally generations, which are preyed upon, but but some of them technically might be considered accredited investors too. So it was a vestige that probably made sense before even I was born, but at this point, I think is really, given the information we have now because of the internet, it really just serves to be an insult. Is really all it does now at this point.
Yeah, and look, obviously it is a challenging solution, but I can tell you one place where people are not locked out of, which is if you went up and you decided to register your name on ENS, Ethereum name service, and you went out and you spent the gas fee to get it done. You wound up with getting, I think, about $8,000 most people received in their account. Pretty extraordinary moment, I think, for a lot of us who got that coin drop. Tell us a little bit about how you think about how that's changing the framework, the conceptual way that people look at this space, at investing, and also about infrastructure build out.
Full disclosure, I got some of those coins because I have 3 ETH names. I have Bianco ETH, I have Jim Bianco ETH, and I have Bianco Research ETH as well too.
So you got 3 coin drops.
No, you only get one. They really try to because all of them point to the same address.
I got it. Yeah.
So they didn't want squatters. Some guy could have bought 837 names to become an instant millionaire.
But
now if you had 830,
on multiple addresses from the alias,
right? If you had 830 different ENSs on 830 different addresses, then you would have gotten 830 times 8,000.
By the way, nobody knew they were going to do a coin drop.
Yes, that's what I was going to say. No one knew that was going to be a stipulation, so almost nobody did that, and that would have been unbelievably bureaucratic to try and keep track of all of those accounts. So I have 3 addresses all pointing to the same account. So I got one drop as if I had one address. But really what they did was they turned the ENS into a public good, and they turned it into a DAO, decentralized autonomous organization. And so the people that own Ethereum .eth names are now given the responsibility to manage the Ethereum name service as well too. And so, I used mine, and I elected Brantley as my delegate to run. So he's got my coins to vote for when it.
Explain a little about what that means for people who are new to DAOs, because I think it's a concept that takes a little bit of time to get your head around.
Yeah, so the .eth address is the same thing as the DNS, the domain name service, .com in the traditional space as well too. So if we are moving to a Web 3.0 world, where the Web 3.0 is an internet just like the current internet, the difference is the ownership of everything in Web 3.0 is going to be by all of the users, as opposed to the ownership right now being these big platform companies, the Facebooks and the Googles and the Twitters of the world. Then your name, your identification in the Web 3.0 world, your .eth address is going to become very important, which is why I got those 3 names as well too. Now, moving forward from here, managing that process is going to be very important as well too. And so by allowing everybody to have a token, when you buy a name, you get a token which represents value in the network, and then you can either vote it yourself or assign, delegate it to somebody else in order to vote the network, is going to become critically important. And what we're also learning is that these tokens have to, by nature, have value to prevent the 51% attack. Well, it's just a governance token. It's just the right to vote on the Constitution and vote on various proposals. So what value does it have? Well, if somebody got 51% of those tokens, they could put up a proposal that says, give me all the power to run the network. Give me all the power to basically take over Web 3.0. Okay, what is it worth what does it take to make a 51% so expensive that you'd never want to do it? That's what the value of those tokens should be, which is why those ENS tokens trade at such a high value right now, because they should. Now, I didn't know that I was going to get them. I didn't know when I got them that they were going to trade at that high a value. Of course, I'm happy when you get an airdrop. Somebody just gives you some tokens that are instantly worth thousands of dollars. But let's understand what this is. ENS is a public good. It's not a private corporation. It's a public good. It is like running Central Park or the New York City Zoo or the Central Park Zoo. And so what we've learned is the current system of governance that we have, where the city council or the federal government assigns a bureaucrat to run something, is not very efficient, doesn't work very well. But when you give people ownership in a public good and the right to then vote on improvement proposals and the like, I think that this is going to be a way to look at how to manage public goods in the future. So bottom line is, for a DAO, maybe, an Apple or an Amazon might not work very well as a DAO, but maybe, like I said, New York City might work better as a DAO than a private corporation. Can't work worse than what we've seen lately.
I'm glad I didn't have to say it, Jim. Look, it's really funny. I was just actually telling this story with Olaf Carlson Wee yesterday. So the day that I got that ENS coin drop, I think it was around $8,000 hit my account. The day after, I went to a party with financial journalists, and these were very sophisticated financial journalists, people who work at big name publications who've been around and watching markets for a really long time. And so I mentioned the ENS token drop, and like several of them were like, well, that can't be right. That's not a thing. You don't just get free money. In fact, one of them went so far as to say that I must have been targeted for this. They know that you're on Real Vision, so they're giving you thousands of dollars so that you can go and talk up the protocols. Like, guys, that's not the way it works. The reality is that you're talking about very smart, very sophisticated people who've been watching markets for a really long time, who hear this and they're just gobsmacked by how strange this world really is.
Yeah, exactly. I mean, the example I would give them again, is, what if we were to assign a token for Central Park in New York City, and every New York City resident got a token, and they got a token that gave them the right to vote on proposals to improve improve the park. And oh, by the way, that token has a value. And the better you manage the park, the more value that token would have to ward off a 51% attack. What would it take? To use an inflammatory name, what would it take for Trump to buy 51% of the tokens and then rename it Trump Central Park? Well, what value would you put on it? Probably infinity at that point. But, I'm joking. But, but all of a sudden, everybody's got a vested interest in just not letting the place fall apart and becoming a mess, a crime-ridden mess, but to actually clean it up and make it an enjoyable place, because we all have a little bit of ownership in it, and we could trade that ownership back and forth with each other. That's why you saw that with the DAO, with the Constitution DAO that wanted to buy the Constitution. Full disclosure, I did participate in that, and I did get some people tokens and still hold them to this day as well, too. And you've seen this explosion of decentralized autonomous organizations that are focusing on trying to buy public goods, or things that should be public goods, like the more popular ones are sports teams. The New York Knicks should be a public good. Well, they're not doing very well as a private good, as you pointed out. And that maybe if there was a token and everybody owned him that was a Knicks fan and all worked together to improve the organization, like I said, it can't do any worse than the way the Dolans are running it right now.
Yeah, my high school years were traumatized by watching the Knicks lose to the Bulls, and the last time they won a national championship was the year I was born. So definitely would be great to see some change there. Listen, Jim, you talk about this and frame so well how radical a paradigm shift what we're talking about here is, how major a dislocation, a disruption, an interruption in business as usual, some of the potential for this technology to truly change the way commerce is done, the way finance is done, the way we live. As we come to the conclusion of this conversation, key thoughts, final takeaways about this technology and the year ahead in 2022.
So hopefully, speaking as a TradFi guy, and hopefully other TradFi people listen to me because of who I am, open your mind to thinking that there's a lot more going on here than we're just going to pump some doggy coin and hope that it goes up or down, and that there's a lot more in this space. The one space that we didn't talk a little bit about is the Metaverse. We don't even quite know what the Metaverse is. The way I like to say the Metaverse is, what did we learn in 2020 from the pandemic? We're all working at home. We're all doing what you and I, Ash, are doing right now. We're talking into our computers at each other. And when I'm done with this, I'll probably have an Excel spreadsheet open and do a little bit of more R programming on something I was working on and stuff. And I always think, boy, this is really still kind of clunky and inefficient. And then if you look to the gamers,
right,
the way that the gamers are setting up their ecosystems of playing games, earning rewards, mentoring younger people, making sure incentives are aligned as well, too. I keep thinking this whole work from home thing is going to look a lot like gaming, because that's the most efficient way that we should be doing it. And it's going to wind up being part of a larger whole called the Metaverse as well, too. So if you're like me, and if you've got some teenage kids at home and one of them is locked up in their bedroom right now playing World of Warcraft or something like that, and you worry about them, They're going to be just fine because they're actually on the cutting edge of what's coming and what's going to be very big as the metaverse unfolds and as the way that we work and position ourselves online unfolds as well, too.
Yeah, absolutely. If you want to look at what the future of network television looks like, go over to Twitch right now and take a look at what gamers are doing and how they're streaming and interacting with those streams. It's really fascinating. I want to get myself a PS5, but I can't buy one of the damn things for less than $1,000 because they're all sold out. Part of the supply chain shortage, part of it is just the demand for those platforms. But I think you're exactly right. Gaming, the metaverse, this is the future of how everything is going to work. This is the future of the UI, the UX, which right now, if we have to be honest about it, in the DeFi space, is pretty weak.
Yeah, exactly. I'll say this to adults that, what are most of our jobs? We sit in front of a computer and manipulate things all day long. Even if we have to drive into a big centralized building and do it in a little room called an office, or whether we're doing it at home. And really, it's kind of inefficient. There's a far more efficient way to do it that's far more interesting. And the teenagers understand that. And that's why they're locked in their room doing it all day long.
Right.
They're not there because they want to punish themselves. They're there because they find it rewarding and interesting. And maybe we ought to look to what they're doing and say, how do I do my job as a financial analyst or a journalist that is like what they're doing in the gaming universe and getting that kind of efficiency and reward to my tasks done as well, too. And that's why I think that the gamers are really on the leading edge of a lot of this. Last thing I'll give you on this, a lot of people don't realize this. If you look at the revenues of gaming worldwide, it is more than television, movies, radio, and all sports teams everywhere, EPL, NFL, everything combined. Gaming makes more money than all of that. It is the cultural force in the world right now. It's not Hollywood. It's not the EPL or the NFL. It's not fashion. It's gaming is really what it is. And that's why I think a lot of what's happening in the crypto space, the Web3 space, the metaverse is coming from gamers.
Yeah, so well said. And I think there's still room in this space for older teenagers like you and I to participate in it. Jim, in many ways, your interest in this space is such a testament to the degree to which this is going to be, I think, a future technology that everyone is going to need to embrace. Jim Bianco has a high opportunity cost of not spending time in traditional financial markets. Maybe teenagers don't, but you do. And so I think just the extraordinary journey that you've been on, that you've been fortunate enough to share with us here at Real Vision, we've been fortunate enough to have you share with us as you walk through the space and you become just extraordinarily sophisticated in the way that you talk about these protocols. We always appreciate having you on the platform to do that. And this conversation was no exception, a really terrific view of what's happening ahead in 2022. Jim Bianco, Bianco Research, thanks for joining us.
Oh, thanks for having me. It was a pleasure to talk about all these issues.
Thanks for watching, everyone.